Hello, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend. Another Browns win this weekend, which is always exciting. It was ugly, but it was a win, so we'll take it. So I'm going to jump right in here with the questions. Thank you, everybody, for joining. First question is from Max. How are you cooking your turkey this year? Little Thanksgiving, in honor of Thanksgiving. In the oven, like always. We don't do the deep frying, but a little bit more expensive for turkey this year, as you may have seen on the St. Louis Fed tweet yesterday. We will not be substituting soybean protein for real turkey like they advised in the Fed tweet. So at any rate, on to real things, or more serious things at least. From WW, what's your view on China? I hear one, they are a gigantic debt bubble waiting to burst, and number two, they're buying up hard assets and racing ahead to take leadership in AI and tech. Very hard to know which is more likely. I think both of those things are happening at once. I think it's both a big bubble and they're buying hard assets with dollar surpluses and trying to get a lead in AI and tech. The whole world's at that bubble, though, and not just them, I would say. And so in my opinion, the key is you really have to look at real-world physical constraints. I think one thing we've learned since 2008 has been that all purely debt problems will just be papered over or extended and pretended and moved on from. And so what I'm really trying to focus on are real-world constraints that can't be papered over. So, for example, in the U.S. baby boomer obligations. As long as those baby boomers are here, there is an obligation to pay them what they're owed. And so that you can't get around that. Supply chain constraints and reliance on China. Those things you can't get around. The boats are either full or they're not, or they're backed up or they're not. In China, they've got physical constraints. It's water, it's energy, it's food, and of course all of these things are interconnected. And so, if the minute one of us hits a constraint somewhere, it begins to flow through into everywhere else. So, sort of a stream of thought there, but I think it's I don't know that there's a black and white answer to that. From QR. Jeff Snyder said that bond market always predicts monetary inflation and suggests there is zero indication of it coming anytime or occurring anytime soon. Do you expect to see multiple supply shock inflation spikes or monetary inflation? If we have financial repression, would the bond market even tell us? I guess I disagree with Jeff's premise. The bond market doesn't always tell us. For example, from 1941 to 51, which is a full decade. It's just a little bit on a chart. It's a full 10 years of your life. Yields were capped by the Fed. The bond maker market literally told us nothing. It told us that there was a buyer, political buyer of U.S. debt that had an infinite balance sheet and a political mandate to inflate away debt. That's all the bond market told us from 1941 to 1951. Bondholders lost a massive amount of money on a real basis. Not nominally. They got paid every dime they were owed, but their purchasing power got crushed for 10 years. There's another example, November 1941. Despite the fact there have been rising global tensions for 8 years, despite the fact that the world had been at war since September 1939, despite the fact that the United States had been supplying one of the combatants to that war since, I believe, 1940, early 1940, the UK, the U.S. 10-year U.S. long bonds were forecasting deflation as far as the eye could see. December 7th, 1941, a month later, Japan bombs Pearl Harbor. U.S. bond market yields back up enormously. Fed comes in, caps yields because war is extremely inflationary. So I understand what Jeff is saying. I agree most of the time. But in these extreme scenarios of I don't know that the bond market always tells anything. I mean, there's something similar happening now. The bond markets are focused solely on the monetary side and the supply chain side, but they're only looking at the ports of LA and Long Beach, basically. They're not paying any attention to more structural supply chain issues such as peak cheap oil and gas, peak cheap commodities. They're not paying any attention to the historical data, which Hirschman Capital showed that 98% of the countries over the last 150 years that have gotten to 130% debt to GDP have inflated the debt away or restructured the debt. 100% of the twin deficit nations. So within context, there's context that exists there. So like I said, I guess I don't agree with the premise that the bond market always tells us everything, particularly in extreme times. And I think we're living in extreme times. From VT, will we see sustained high inflation, continued massive U.S. government deficit spending while the dollar climbs due to global demand for dollars? All global fiat is devalued, but the U.S. dollar devalues the slowest. Yeah, this can happen, but can only happen briefly. We saw something like this in 2018. And then in 4Q18, the stock market fell 20% in a quarter, which was one of the biggest quarterly drops, peak to trough, in history. So why can we only see it briefly? U.S. net international investment position of negative 70% of GDP. U.S. stocks effectively are the economy now through the consumption link. Emerging markets are the majority of global GDP for the first time in 300 years. Emerging markets are the majority of global oil consumption for the first time ever. The U.S. is the world's biggest high-cost oil producer, which through the EM link starts to make the U.S. industrial sector look a lot like an EM. U.S. shale is a key component of the ISM, as I said. The higher dollar will hit the emerging markets, and then they'll sell dollar assets. They'll hurt U.S. consumer spending through the dollar asset fall. That will filter into GDP. They will cut back on oil buying, which will hurt oil prices and therefore U.S. ISM. And so the lag on all of this happening to me is the $64,000 question. We're coming off a very hot economy, and so maybe that buys us some time relative to what we saw in 2018 in terms of this rising dollar, rising rate, rising stocks combination. The debt levels out there would all else equal make this shorter, though. So I think it's likely measured in months in terms of from when the dollar gets quote unquote too strong to when the dollar to when we start having risk off, higher volatility, etc., weaker U.S. economy. Maybe 2 quarters at the most if the dollar rise continues. So let's watch. From Brian, hi Luke. Obviously not selling any Bitcoin itself, but would you consider selling the Bitcoin stocks when Bitcoin reaches what we think might be a peak in this cycle? Stocks all bought last year and early this cycle include MSTR, MARA, HUT, Coin, and then the Grayscale Bitcoin Trust. I don't have a view on any of the Bitcoin names. For myself, I just keep it simple. I don't know enough about those names to take a position with any conviction. So I just buy Bitcoin. It probably takes away some upside maybe if you know the names and can trade them well. But for me, it also takes away the management execution risk. I don't want to have to worry about that. I want to own the Bitcoin. So I take a simplistic sort of plain vanilla chicken view, but that's that is what it is. From Tyler, going further on the Jeff Snyder, Lacey Hunt interest, is the real game changer in the inflation-deflation debate MMT or UBI, Universal Basic Income, and putting money directly into ordinary people's bank accounts? Look, if you read what Stan Fisher, former Fed Vice Chair, said in August 2019, what Ben Bernanke said back in 02, December of 02, what they did last year was helicopter money, full stop. It was effectively UBI. We got our inflation as a result of it, right? I mean, they ran massive deficits. They gave the money to consumers. The Fed monetized those deficits. That is a classic definition of helicopter money. And we got our inflation. We have the highest inflation in 30 years. So the question we've long been asking this whole time is will they keep this up? How long will they keep it up? Will they keep it up? They need to keep it up given the debt levels where they are, but will they? Ultimately, since money is fungible, dollars are fungible, as long as the U.S. government is running deficits and as long as the Fed is doing QE, that's helicopter money effectively. That's basically the government handing money to somebody and the Fed monetizing it in some amount. The question is on the margin, are they doing more or less? Obviously, they're doing less. I would agree that UBI would take it up a notch, probably make it much more inflationary, much more effective. I think UBI is inevitable on some level at some point, but you probably need political cover, in the form of a crisis. And I don't think we're there yet. That ties back to that how strong does the dollar have to be before things start coming unwound question. From JE and EC, 2 questions here. What signs would likely come before U.S. gold revaluing, and what actually would be the effects short and long term of a gold price adjustment overnight to $10,000 per ounce, and not for the balance sheets of the Fed, but for companies and households? So I think we're seeing a lot of the signs. Rising debt levels, cessation of foreign central bank treasury buying, Lacey Hunt's net national savings as a percent of gross national income falling back to 1933 or 2008 levels when you had dollar devaluation to sort of jumpstart things. We got that last year. Gold moving back into the system on some level as reserve asset. BIS net stable funding ratio rules for gold changing in London to some extent in January. That seems to be a move to get the banks back on sides. As one of my best relationships on Wall Street says, it's a situation where there's just sort of any given Sunday. If no gold revaluation happens in the next 5 years, I probably wouldn't be surprised. If it happened this Sunday night, I probably wouldn't be surprised. But I think you need some sort of crisis that where consensus thought goes from where we are today, which is this is just another rate hike cycle with GDP growth, to realizing they're not getting out of this without some sort of gold revaluation, balance sheet recapitalization at the central bank level. And we're not there yet. I see it on Twitter. I think consensus is that this is just sort of a normal post-recession growth rate cycle, and I think it's very different this time. It's not different than what we saw in other sovereign debt bubbles, but it's been a long time since we've had a bursting global sovereign debt bubble. In terms of what it would imply for companies and households, it would be inflationary on a lag. It would depend what the government did with the money. Again, the accounting of it is pretty straightforward per the Fed operating manual. If gold was revised to $10,000 per ounce, if the Treasury instructed the Fed to do that, the mechanical implication of the accounting balance sheet entry would be the Treasury General account would have every $4,000 in gold is about $1 trillion. It would deposit about $2.5 trillion into the Treasury General account, which Treasury could spend however it saw fit. And so how would it affect individuals and businesses would depend on what they did with that $2.5 trillion. If they plowed it into one sector of the economy as stimulus, debt forgiveness, whatever, that's where you would see your inflation, and then you'd have a Cantillon effect from there, in my view. And then the last question for today from WB. Luke, do you consistently recommend a position in Bitcoin? Do you recommend any other Tier 1 tokens? I do own a little Ethereum as a play on sort of the Web3 theme, about which I am still learning in very, very early days, and which I have no strong feelings about one way or another, and I'm not even very educated about it at all. So it's a very small position. Like I said, I do own a little Ethereum, but that's it. So with that, I will finish up for tonight. Thank you, everybody, for joining me. As always, if you like these updates, check out FFTT-LLC.com for information on what we're up to, and can learn a little bit more about our Tree Rings product, 10 most interesting things every Friday. Quick synopsis of what we thought was interesting about them and whether they agree with, refute, confirm different things that we see developing in the global economy. So thanks again, everyone, for joining me. Everybody have a great Thanksgiving here in the U.S., and we will catch up with you soon. Take care, everybody.